Before you invest your money, it's important to understand one thing. Every investment comes with risk. Knowing these risks helps you make informed financial decisions instead of emotional ones. Let's look at the 5 major investment risks. Inflation risk, liquidity risk, credit risk, market risk and price risk, interest rate risk. Let's go detail about each risk one by one. What is inflation risk? Inflation risk is the risk that your money loses its purchasing power over time. For example, 100 rupees can buy more groceries today than it will after 10 or 20 years because prices keep increasing. This means that even if your investment grows, if it grows slower than inflation, your real wealth actually decreases. The key takeaway: don't just invest for returns, invest for returns that beat inflation and help protect your purchasing power. What is liquidity risk? Liquidity risk is the risk of not being able to convert an investment into cash quickly without losing its value. For example, if you invest 5 lakh rupees in land and need money urgently, finding a buyer may take time, and you might have to sell at a lower price. But investments like mutual funds can usually be redeemed in just a few days. Always choose investments that match your liquidity needs and financial goals. What is credit risk? Credit risk is the risk that the borrower or company may fail to repay the principal or interest on time. For example, if you invest in a company's bond and the company faces financial difficulties, it may delay or even stop making payments, causing you to lose money. The key takeaway: always check the credit quality of the issuer before investing. Higher returns often come with higher credit risk. What is market risk? Market risk is the risk of losing money because the overall financial market declines due to factors like economic slowdown, inflation, interest rate changes, or global events. For example, during a market crash, even strong companies can see their share prices fall because the entire market is affected. Market risk cannot be avoided completely, but you can reduce its impact through diversification and long-term investing. What is price risk? Price risk is the risk that the value of a specific investment may fall due to company performance, market demand, or negative news. For example, if you buy a company's shares at 1,000 rupees and the company reports poor earnings, the share price may drop to 700 rupees, reducing the value of your investment. Price risk affects individual investments. Research and diversification can help reduce its impact. What is interest rate risk? Interest rate risk is the risk that the value of your investment changes when interest rates rise or fall. For example, if you own a bond paying 6% interest and new bonds start offering 8%, your bond becomes less attractive and its market value may fall. Interest rate changes mainly affect fixed income investments like bonds and fixed deposits. Understanding this risk helps you make better investment decisions. Every investment carries some level of risk, but understanding these risks is the first step toward becoming a smarter investor. Whether it's inflation risk, liquidity risk, credit risk, market risk, price risk, or interest rate risk, each one can affect your investments differently. The key is not to avoid risk completely, but to understand it, diversify your investments, and invest according to your financial goals and risk appetite. Remember, informed investors make better decisions. Invest wisely and stay financially aware.